Hello everyone, another webinar as we're moving into the first, as we actually going through the very first month of the year. So I've decided to have as two of my main webinars this month to be a more advanced ones, I should say. I know that putting it all together, entry, target, stop loss, risk and money management sounds like basic, but it's not. It's not. Okay, we're not going through. We're gonna see the general behavior approach technique that a trader should have in order to and how it could combine all this for the best interest. So I need to go through the disclaimer as usual. As you already know, for any, as you already know, sorry, I would really appreciate the feedback in regards to the audio, visualization, and the and whether you can see my screen and so on and so forth. As always, I need the feedback to confirm that everyone hear me loud and clear. This webinar is recorded as usual, so you're gonna receive the recording once we're done. And I think that's pretty much it. I have put two handouts on as well. I have put the handout of the slides, also an extra one in regards to um, our mine and your system, just to give you just to help you understand what we mean by system, and how you can. It's like a checklist for those that watch our webinar called Trading Journal. You will understand that we keep saying that it's good for you guys if you have a system to create a table and write down every morning anything that triggers your attention. Okay, good evening, very happy new year to you as well, Ganesh, and to everyone, guys. The current trend one is okay. Are you referring to the PDF? At any, this is on your end. If you cannot open the PDF, I think it's on your, the problem is your PC, because everyone else. Oh, wait a minute. So Kenneth downloaded. Oh no. So none of you can download the. So you were able to download and open the current trends ones, but you couldn't download and open the putting it all together. Oh God, why this is happening? It happened to Stuart as well. He mentioned it to me, but I can't see that it's here. Let me try something else then. Why is that? Why is keep doing that? You're absolutely right, guys. Okay, let me try something else, okay? I will delete it. Okay. So that's why Stuart had the same issue. Okay. Give me a second, guys. Give me a second, please. I don't know. So it seems that it's not okay. Other than that PDF, what else there is over there? Okay, I'm uploading it once again. and let me know whether you can open it, please. It's 100%, so it's done. Can you guys try to download the one that I have just uploaded and let me know, please? Yeah, the thing is, Makun, I can send it to you via email. I know that, but it's easier for us to put it as a handout over here. Why? Because you're here. So we had 143 people registered. So far, 24 attendees. So it means that I need to send it 24 times. Oh. Okay. Okay. Okay, I will send it to you to save time, and I will try to see with the company, with the marketing team, what's going on. So let's start because we have plenty things to cover. This is the part one webinar because it's too much, so I split them. So disclaimer, this material provides a general market communication for information purposes only and does not constitute independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk, for which the user is solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full risk disclosure in our website. Okay, so we are good to go. I will skip myself. We don't have the time for introduction. So what we're going to cover today, guys, is, as it sounds, it's pretty much everything. So you're going to see how I'm going to show you our system, but also in general what steps you should follow in order to find entry levels and enter actually your trades, setting targets, setting stop losses, risk management, and of course, as we're going through the webinar, feel free to ask anything you want. Okay. Okay. Mhm. Okay, so uh, give me a second, guys. Okay, so yeah. Now, putting it all together, so market participation. So guys, the steps are pretty much clear, I think, at least for the ones that are a bit experienced, the people from you that they're a bit experienced in regards to trading. So entering the market, trading actually requires, of course, some knowledge, but the actual practical way, the actual uh, way to we should behave, the actual steps that we should take in order to participate in the market is these 7-step simple steps. So first of all, you have an initiative, right? You want to succeed in trading. You want to gain some money, right? We don't do it because we are doing it because we want to gain, right? So we have an initiative. So, and how we could do that, the very first thing, practical, okay? I'm saying practical because it's not the very, entering a new position is not the very first thing that a trader should do. A trader should educate itself, first of all, to understand, to learn technical indicators, to learn fundamental analysis, and so on and so forth. Now we're referring to the market participation, the practical way. So for participating in the market, for participating in the trend, first of all, you have an initiate, and you initiate. So what you are aiming to do is identify a trade and entering a position, right? Now, so whether in the so once you have entered a market, it's not just that. It's not just I enter the market and just um, uh, leave it as it is. Okay, you might consider, um, depending, of course, depending on whether you are scalping or you are in a long-term trader, etc. You might consider the next day or the next hour, and etc., to scale in. So to add to a position, right? To increase your exposure of that position, or to open another one on the same direction. So to add to a position, or if that something it doesn't really goes as you believe, you might decide to reduce the position, so scale out. What do I mean by reducing is like either setting your stop loss closer in order to lock some profits and to limitate your risk. So because there might be some contradictory signals from your indicators or from your candles, um, uh, like signaling that, you know what, something is going wrong. It might turn against you, etc. So you might thinking of reducing a position to scale out, or even exiting, closing your position, either because it hit your target, either because it hit your stop loss, or either because you want to close your position because for any reason, because you won't be available to watch the market, because you believe that it was a wrong decision, uh, for any reason. So to square off. Fifth, re-entering the same or opposite direction. So what is that? That's adding to a position. Okay, re-entering in the same direction. So opening multiple positions. Okay, or hedging, or opposite direction. So, okay, actually it's a bit different. So re-enter in the same position, the same direction. Okay, so you can see that the trend is strong, so it will continue moving. It's expected to continue moving on the same direction. And you are telling to yourself, oh, that was a good decision. It's good that I enter. I should open more. I should open another position on the same direction because it doesn't look to run out of steam. It looks that they will continue moving higher, and so on and so forth. On the other side, however, okay, if you have entered because of an upwards trend, for example, in the daily chart, and you had open positions in the daily chart, that it will go up, it will continue this uptrend, but you're going down the 1 hour chart and you see a correction. You decide that you know what, I have my medium-term positions open, my daily position open, but intraday it looks reversing in the 1 hour chart. So why not taking a short-term position on the opposite direction? Okay. So this is ways that someone, you don't need to necessarily follow everything, right? It's just different ways, different systems for someone to participate in the market. So, or hedging a position. Maybe you have a position open, but you see that it's probably it was a wrong call, so you decide to hedge it. So what that hedging a position means is when you in order to reduce the risk of adverse price movement in an asset, okay, you are taking you're taking an offsetting or opposite position in that particular asset. So hedging is a strategy, okay? There are people that they use hedging as their main strategy. So hedging is a strategy that tries to limit risks in uh, in assets. So um, some popular techniques, hedging techniques, are involved in taking offsetting positions in derivatives that correspond to an existing position. Other type of hedge can be constructed via other means like diversification. So pretty much how the hedge works is that hedging is somewhat analogous to taking out an insurance policy. So what I'm trying to say is that if, for example, you own a home in a flood-prone area, you will want to protect your asset, your home, from the risk of floating, right? To hedge it, in other words. So you are taking out flood insurance. So in this example that I'm telling you about the house, you cannot really prevent a flood, but you can plan ahead of time to mitigate the dangers in the event that the flood did occur. Okay? So what I'm trying to say, of course, this is not a risk-reward trade or a trade-off. Um, I mean, hedging is not free, right? In the case of a flood insurance policy example, you have a monthly payment to the insurance, and if the flood never comes, the policyholder receives no payout, right? So you keep paying month after month your insurance. So hedging works in the same way. So you're hedging in the trading industry in order to reduce and control your exposure to risk, right? So if you're holding a particular position in an asset, okay, but if that position turns against you, so you think that it might turn against you, is a risky asset. Fundamentals, long-term fundamentals are not pointing to the direction that I have taken. So you want to ensure or to try at least to limit your risk. So what you're doing is also setting a pending order on the opposite direction, stating that if my asset um, comes below that level, open an opposite direction position. So you're trying to limit your risk. Or you can open a position. I mean, either as a pending order or as a opening position on the opposite direction, but in a different time scale. So there is so this is a different approach. Of course, we have webinars on hedging. So if you've seen something that you will interested into, feel free to watch our webinars for hedging strategies in order to realize what is hedging and how you can implement it in your daily routine. And seventh, and one of the most important things, is that all these steps that we have went through should be placed on the violation or penetration of a price triggered, not merely a signal. Okay, so hold cash. And I remind you in this point that regardless of how many trigger points you have identified, how many positions you have open, whether you're hedging or not, make sure that you don't risk all of your money, all of your balance. Hold cash, hold some of your account on the side. Don't risk everything, okay? So triggers and signals, right? So everyone from us, every single day, what we're trying to identify is signals, trigger points, something that will confirms to us and makes us feel confidence that, oh yes, this is probably will go on that direction because of this and this and these reasons. This looks a nice entry point, it's a nice trigger point, it's a strong signal, right? This is what we all aiming to achieve. So triggers are what I call triggers are literally the entry levels. Okay, it might be trend entry levels, so an actual price, or it might be non-price based, so it might be due to some filtering. So maybe due to an entry point that I found based on the moving average direction, or some entry point that I have identified due to the break of RSI above 50, or due to an entry point that I have found due to volume. So it's not necessarily a trigger point is not necessarily price one, it might be non-price one. Okay, of course price based ones are the best because they imply that um, that a lot of it's a why they are the best, because they tend to be stronger signals than non-price ones. And non-price ones favored by systematic or algo trading. Okay, that's why price-based ones are considered to be more reliable or better. So yeah, I think every one of you are using price triggers, right? Am I wrong? Am I right? So this is briefly, very briefly. You know me, you know Stuart. You are participating in our live analysis, so you pretty much know what indicators we are using, what setup we tend to have, right? So I will repeat all this once again just to give you an understanding what we do. First of all, what I like doing every morning, every single morning, is scanning my charts, and I'm referring to the daily charts. So I really scan through the daily charts and have a look on my daily candles. Okay, why? Because guys, checking your daily candles, so like the very first thing that you do in the morning, helps you identify overall trends, overall momentum for each and every single asset that you are interested into, right? If you have 40 charts, go through 40 charts. It's not a lot of time. I mean, it might be less than 20 minutes if you have all of them like we do. So we have 40 charts of currency pairs. I have US oil, Brent, UK oil, gold, silver, copper, and the major indices such as S&P, FTSE, DAX, Dow Jones, and I also have actually um, uh, cryptos as well, along with some of the major shares, to be honest, lately, like Apple, Tesla, Netflix, and etc. So it's good to scan daily. Very first thing that you should do in the morning to scan your daily candles and to check. Actually, what you should check is okay, depending on where you are placing the word. I think that most of you have similar um, time zone with us here in Cyprus. But okay, I'm in the European Open. I'm going through the European Open, so I'm not here in the Asia session, but I'm here in the European Open and the very, very beginning of the US Open. So what I do every morning is checking the daily charts and checking more precisely how the candle, the daily candle that closed at 12 o'clock midnight, end up and how strong it was, the body, the tails, whether it break any support and resistance level, any moving average, and so on and so forth. So with this way, I will be able to take my entry as soon as I scan my charts before I can take my entry before the European Open. Okay. Of course, you need to adjust everything that I'm saying based on your time zone. If you are a person that you are placing in somewhere in the world that you don't really trade in the European session, but you're trading the US Open. So before the US Open opens, you should actually scan your chart and check the previous daily candle, how it closed before you decide to take an entry, and so on and so forth. Of course, you should take an entry only if it fits, if you are confident enough for that particular observation that you have seen. Okay? Always stop loss and take profit. I'm not gonna go through that. You know why this is why you should place your stop loss and take profit, because you need to limitate risk and you need to limitate risk, and if you set them in the appropriate distance, you can avoid any noise in the market and you will feel better. You won't be emotionally driven, and so on and so forth. So um, um, we have said before, we said that you can add in a position. So adding in a position implies to either shifting stop loss closer, but be careful, this has risk as well. Okay, because if you set it too too close, you might end up hitting the stop loss. So you need to do it properly. Okay, everything has like some limitations, but adding to end position implies to open to add more targets in that particular position. We have a whole webinar stating covering ways to have multi-targets. Okay, so adding a position is also having multi-targets or opening more position of the same asset on the same direction because the trend looks strong. Okay, but every single position that you're gonna have, you need to set your stop loss and take profit. Okay, risk management managed by lot size and is absolutely vital. Okay, the risk management and money management is something that I'm going to cover in this next part 2, but um, managing your position is vital because with this way you're saving. You are risking just a small portion per trade of your whole account, and you don't uh, uh, risk all of your money in a single position. Um, um, Also, another way of risk management is having multi-targets. You can say, okay, I have I have set two targets in this position. I have $1,000 for this particular position. I'm gonna risk only $100, so I have in balance 900 remaining. So from those $100, I want to risk 80% of those money on the first target and the remaining 20% on if the asset hits target 2. So is so with this way you will be able to lock profits if your asset hits target 1 but fails to hit target 2. Okay, okay, so over here I have tried to, with the help of uh, of um, um, so um, so yeah, over here I have sum up with the help of Trevor's. I'm not sure whether you are aware of Trevor. Um, uh, I watched lately one um, of his webinars, and I thought that, oh, that's very, very interesting. It will definitely help our clients. So Trevor Nail is a very, very famous analyst, economist, and etc. So he was giving a webinar similar to the one that we're doing today, and he summed up a lot of common signals that traders tend to use. So I have put everything on because it might help you, or it's something that you might want to experiment with, one of those. So you want to test yourself whether in regards to divergence signals or in regards to uh, to I don't know. You might want to add something of all these common signals in your existing system, or I'm just giving you some inspiration for testing. Test first, not in a live account. If you want to try something new, test it in your demo. And if you identify that is a good addition on your system, then feel free to try it in a live account. Okay, so there are plenty. I mean, there might be more than the ones that I have put on, but these are some of them. So some of the most common ones. Okay, so people, we have mentioned in the past what divergence is and what kind of signals it can give us. So divergence, just briefly saying, is when our price moves in a different direction than than an oscillator, I don't know, than an oscillator or I don't know, a momentum indicator and etc. So this is signals. Divergence provide a signal that, you know what, the price moves up, but your indicators is keep detecting. So we have a divergence. So take care because you might have a reversal in your a potential reversal in your um in this asset. So they give us some signals. So common signals are if we have divergence between the price and overlay, if we have divergence between price and oscillator, if we have divergence between phases of similar oscillator, okay, or if we have divergence between different oscillators. So having, let's say we have MACD, We have RSI and we have ADX, but they diverge. They are pointing to different, they're giving the opposite signals. So this divergence based on different oscillators is something that triggers it should trigger our attention, and we should do some appropriate technical analysis based on a potential reversal of the asset, or intermarket divergence. Okay, intermarket divergence is not something which just works on the stocks and bond markets. Okay, it works also on gold, oil, copper. So I'm not sure. No, I don't think we have ever done something on intermarket divergence. Um, so uh, so intermarket, actually we did sorry, intermarket intermarket divergence. Just briefly speaking right now, guys, intermarket divergence refers to the method of checking correlated assets. You know that there are some correlations in the market, right? Um, um, so, for example, Aussie dollar with gold, or dollar CAD with oil, right? So intermarket divergence studies the correlation between markets. Okay, and uh, checking, let's say, oil, how oil is doing, what is it pointing, where is it, what kind of signals it generates, and checking then the dollar CAD, what kind of signal it generates. So um, um, you're checking correlated markets, you're checking uh, um, um, you're checking whether they give similar or different signals. Another example is S&P 500 and bond market. So S&P 500, for example, with 30 years bond. Okay, so these are positively correlated assets. Okay, so if the bonds goes up, S&P is expected to also go up. Although this is not always true, bonds should generally lead stocks at turning points. Over the history of S&P 500 and 30-year Treasury bond is the fact that one of the best trades you can make in the S&P 500 is when the 30-year Treasury bond diverge from the S&P 500. So, for example, when a bond is rising, or when the bonds in general are rising and the S&P 500 is falling, some people that they like, they are trading based on the divergence, they tend to buy the S&P 500, okay, because they have noticed that bonds were rising when S&P 500, so that implies that in the near future S&P 500 will start appreciating again. So it's right, buying the dip condition. Or B, if bonds are falling and S&P 500 is rising, then we tend to sell the S&P 500 on the perspective, on the potential turn lower due to the falling of the bonds. Okay, this was just an example to make you understand what I mean by intermarket and divergence. There are other signals. So give me a second, guys. Sorry for that. There was a really, really loud noise in the room, so I couldn't really hear myself either. So intermarket divergence, or I know that I don't think that you're trading on divergence. I think you're more or less a more technical traders. I guess. I don't know. So you might probably like the rest that I'm gonna cover. So we tend to check patterns, identify patterns that they might give us signals like bullish equilibrium line, ascending, descending triangles, head and shoulder formations, cup and candle. So checking patterns, also common signals, or simply checking our oscillators and our price. So whether MACD is turning negative, whether MACD is turning positive, whether stochastic is pointing lower. Okay, more straightforward signals. Or whether our oscillator is at 0 and 50% gross, or whether our oscillator points to some kind of a um, oscillator chart pattern violation, so a failed swing, or whether our asset broke, whether our oscillator entered overbought of or oversold levels, so it's time to reverse because it's reached oversold condition or overbought conditions, or whether our oscillators overlays tests or breaches. Whether we have signals derived from sentiment, market breadth, statistical, seasonal, behavioral indicators, and so on and so forth. So all these are common signals that we might already using, or you might consider adding into your existing system. Now, if you are more or less a price-based trader, so you identify your triggering levels, your entry points based on the price, then you're probably using some of this that I have put on, the breakout of the previous support and resistance levels. So this is a price-based triggered, or overlay indicators, so like moving averages, trend line, channels, bands, Fibonacci's, gun levels, in Chikumoku cloud. So all these, or pivot points, all these are triggered levels. For example, if our asset broken 20-day moving average in the daily chart, broken it and closed below it, that's a short position. Or if my asset broken above the 38.2 Fibonacci level, then I will enter the market targeting the 50% Fibonacci level. So different by price-based triggers, or derived prices levels based on sequence, such as if you're using Renko, if you're using Guppy count backlines or 2-bar breakouts. So, okay, that's a bit more advanced sequences. Other than that, Renko, I don't think we have covered in the past any of the others. So we'll leave it for now because we haven't going through these terms, so any bit more advanced ones. But yeah, we have actually, yes, we have done Renko. So yeah, Renko is an example of how you can find the trigger point by based on Renko, on a sequence of bricks, or very simply, very straightforward, and break of highs and lows. So if I open my MT4, there is an indicator called high and low. Where is it? It was somewhere. Here it is. Oops, what have I done? Yes, okay. So here it is. Buy, it has automatically done for me, apply for me the high and day of the day, high and low of the day. So you know that if your asset breaks this existing high in the next few hours, then that would be an entry point to the upside. If it turns down and break the low of the day, the low or the so far low of the day, that could be a short position. Is a signal that, so if, to be more to be precise, if on the big this morning I had, so this morning, I am here around 9 o'clock. So if I had scanned my markets and I had put on the high and low indicator, the high and low will have been over here. And the low, yes, low will be the same. The high will have been over here because I came in the office at 9 o'clock, so it was here. So if I had this indicator on this morning, I would have entered once it broke it. So over here, very straightforward, right? You should use things that are making sense to you and they are straightforward and you can understand them fully. Okay. Now, I'm giving you ideas, guys. I'm giving you food for thought, food for testing. Okay. Also, just to clarify a few things, a signal is a signal. Okay, is on you, is your call whether you will leave this signal as a signal or whether you will actually make it uh, uh, real. I mean, to actually use it. Okay, signals are either bullish or bearish, so they are indicating a potential bullishness or bearishness of the asset. So it signal is a signal. I mean, it's something that oops, it's something that is calling for us, is shouting to us that, whoa, your asset might go up, your asset might go down. So it gives us some alerts, but it's on our call to check whether this signal it's it's a good one or not, whether we will trust it or not, and how we achieve that using more indicators and checking whether they agree with that initial signal. So it's a setup. Signals are a setup, which is our setup, the setup that we have developed, which alerts to a potential price trigger in anticipation of a reversal or a breakout. Signals can also be based on overextension or exhaustion of the price or oscillator or overlay. So it might not be solely, we might not solely take a signal because the high and the low of the day broken, or because the price broken our support and resistance level, or because it broken the moving average. It might be non-price one, so it might be due to we might have signals from the actual oscillators. For example, RSI is overbought. If it's overbought, then implies that it will eventually rebound away from the pull back away from the overbought condition. If it's oversold, it will eventually rebound from the oversold condition. So we might have this kind of signals as well. Or not only oscillator, price as well. So if, for example, we are using Bollinger Bands. Bollinger Bands are providing to us some kind of range. So here, nice. Okay, it's not the perfect example, but it's something. So over here, we know that if the asset is outside our Bollinger, it means that it's in an overextended condition, an exhaustion. So we have checked over here, we have seen over here, or here as well, that the candle closed outside Bollinger. So it means that it's oversold. So what that implies that it will, in the next few hours or session, it will either rebound or consolidate because it had reached to an overextension, to an exhaustion. So indeed, in the next few hours, it was consolidating in order to find the strength to continue downwards. Okay, so the fact that it closed outside Bollinger, it was a hint, a signal of overextension, stating to us that it will either rebound or it will consolidating until it gain more momentum to continue the downside. Let's move on. No questions so far? What is wrong with non-price signals? This is clearest when we have a significant divergence between the price and an oscillator or indicator. Standard divergence will often misdirect us or our system into believing that the trend is changing because of the momentum loss. We also have something called hidden divergence. So hidden divergence may indicate the trend is reversing when it is actually continuing. So you need to be careful. Not all signals are accurate signals, are good signals. Okay, they might be wrong as well. That's why you might need another indicator, or you might need to go a scale higher on the time frame or a scale lower on the time frame to check what's going on in the other time frames, and to criticize a bit your signals to check whether it's a good one or not. So you need to be careful, especially with the non-price signals, with the signals that are based on indicators or divergence, and etc. Because the indicator might provide some kind of a signal, but the price might don't the price movement, but might come in contrast with the indicator signal. So everything needs to point on the same direction in order for you to have a strong signal. Okay, trend change should be confirmed by the price action. Price is your confirmation of the message of the signal. So if you're taking non-price signals from indicators, then you should go up to your chart and check the actual price action to check whether it gives you the same direction. Okay, you need to always have the trend as your friend. Is the most powerful weapon. Okay, I think you already know that our system is looking for energy, for turning points, for trend. That's why we have always in our setup 20-day moving average, whether actually 20, 50, and 200. A breach and break of 20-day moving average, it's a signal for us on whether the asset is ready to reverse or it should rebound or will start an upwards trend. For example, we have the ATR for setting target areas, target levels, sometimes a multiple one. So using ATR solely for first target, or twice the ATR for setting my second target, and 3 times the ATR for setting my third target, and so on and so forth. Stop loss, either using 1-to-1 risk and reward ratio, so the stop loss should be equal with the ATR number, or using a part of ATR, or using my immediate support and resistance levels to set my stop loss, or the high and the low of the day for setting my stop loss, or using Fibonacci level to set my stop loss, fractals, RSI, and so on and so forth. There are plenty of things that you can use. Now, let's see a bit more interesting stuff, such as an example of S&P 500. So I'm using that. Sorry, guys. So it's an example for giving you an idea what we mean by good or bad signals. And in this case, it's a good or bad divergence messages. So you need to be careful. You need to be careful. So that's why I'm giving this example. So over here at the very, very beginning, okay, we have seen lower lows, right? Are you with me, guys? Am I speaking to myself? Are you here? Are you okay? For the last half an hour, no one responded. That's why I'm worrying. Listening. Okay, perfect. So over here, lower low. So we have put a small trend line because we have connected the lows and we have seen that the trend is going down, right? And I came down to my that okay, that was actually an ADX. Let me check whether I can't I can't fix it. Can I fix it? No, I can't. What have I done? Oh, maybe I can show it to you over here. Over here. Yes, okay. Okay. So, okay, yeah. So here is RSI. Sorry, the index is in a different example. So okay, can you see that? I guess you can. Let me just so over here we connect lower lows and then we went down to our RSI and check how RSI is doing for that particular section of our price uh, price from a particular section that we have seen the lower lows, and we have seen that the RSI is moving on the exact opposite direction of the price action. So by connecting the lows, we have seen it pointing up and not down. So that was the very, very first signal that the trend could reverse. So it was a divergence signal that the price, the asset might potentially starting moving higher. So that was a nice, good divergence signal for the S&P 500 over here, because indeed afterwards it kept starting going up and up and up and posting higher lows and higher highs and forming an uptrend. A bad signal. Okay. We have identified, we have started seeing this trend, we connect the lows and we have seen that there is an uptrend in the market. And we kept monitoring our RSI as well. But over here we have observed lower highs and not higher highs like here. So here we had a divergence, okay? Here we have seen a divergence. But be careful, guys. It doesn't necessarily mean that the asset will start sloping lower. So you need, if you've seen a divergence, you need to confirm. You need to wait a bit, be patient and confirm. So you have observed, you have seen this diversion. Okay, you have put this trend line on, you have put this trend line on, you wrote it down and you were checking it day after day. But you couldn't see a reversal because your asset was keep rising higher and higher. So this is a false divergence, a bad divergence signals. And if you had also another indicator such as MACD, you should have seen that it kept moving positively well above zero level. Okay, there was some kind of a consolidation over here, but afterwards it was keep rising and rising. So that was a false signal because neither MACD, neither the price action agreed with this divergence. So that was a bad divergence signal and you should ignore it. Okay, but look at a nice reversal signal, a nice divergence is this one. Because in contrast with this divergence is a more powerful one. Why? Because MACD and RSI agree by connecting the highs in MACD and the highs in RSI, they both pointing downwards, right? While the price was moving higher, so we had a divergence, but a strong signal. Okay, so that's why this is a good signal. Oops, that's why this is a good signal. This is a good signal as well, but this is a bad signal. Okay, because the difference between these two and this one in the middle is the fact that you have two things agree. Okay, you have more than one thing, this indicator that agrees. In this case, RSI and MACD were in agreement. In this case over here, what was in agreement? It was the RSI and MACD as well, because we have seen, sorry, we have seen MACD over here. You might haven't observed it, you might haven't notice it, but MACD over here is below zero. So negatively configured MACD, so it's negative, so suggesting negative momentum. RSI, sorry, actually, yeah, that's my bad. So we had a negative MACD, yes, but failing to overcome zero line. But on the as soon as RSI broke 50 and moved higher, the same stands for MACD, which eventually entered positive territory over here, right? So we had MACD positive, RSI positive, both pointing higher, and at the same time we had a breakout of the uh, uh, we had the breakout of the price action uh, of the immediate resistance area, something that suggests that momentum has changed. So what you were waiting, it was for a sign that price moves above this resistance level. And indeed that happened over here. Okay? So you need to wait for the next few sessions, next few days, next few weeks, depends on what kind of trading you're doing, to confirm whether this is a bad or a good divergence signal. Okay? Now, objectives. Objectives. Predetermined price level to exit or adjust position management, often called take profit levels. So there are different types of targets and objectives for each one of you. So each one of us has a different approach, has a different objective, right? So these are like some, actually they are the uh, different objectives, different targets, and etc. There are traders that they are really keen to open some buying or selling limit orders at the profit level. Some other are using buying or sell stop order, reacting to reaching their objective. There are others that they are based their targets on a pattern based one, so using Fibonacci's for setting their targets. So they're using patterns. They might use the edge, the upper or the lower trend line of a triangle. They might use the neckline of a head and shoulder and so on and so forth. There are others that they are based their objective, their targets on risk and reward ratio. They are saying, okay, I have found a trigger, I have entered the market, so I want to gain triple of what I'm risking, so I'm gonna set my stop loss based on my ATR, but my target will be 3 times away. Okay. Or there are others that they put as target, they are some technical levels, such as pivot points, Ichimoku lines, support and resistance levels based on the previous, on the historical levels. There are others that they are using moving average or trend lines or Ichimoku cloud or Fibonacci or gun levels as their targets or stop losses. Or there are others that they are using point and figure chart. So briefly, point and figure charts is one of the simplest systems for determining solid entry and exit point in the market. So it's a system that monitors supply and demand for each asset, but at the same time is keeping an eye on developing trends. So it's not a very common, very popular technique. But what you should know is that it's a way to visualize price movements and trends in an asset without regard to the amount of time that passed. So point and figure charts utilize columns consisting um, of stacked X and O or O's, each of which represents a set of amount of price movement. So X illustrates rising prices, O's illustrating falling prices. So it's a different system, not very common. It would be good if we had a webinar based on the point and figure charts, but it's not very common, so and it's a bit tricky as well. That's why we haven't done it any yet. But I will think about it. I might add it in the future in our webinar schedule. Or other objectives or target areas could be based on the on patterns again. So doji star, evening star, double top, double bottom, twizzler top, twisted bottom, and so on and so forth. This is this is the point and figure chart. So so it's measuring it's measuring points and figures. Okay, I will leave this. I have this in the slide. You can study it afterwards. And now we're gonna shift quickly to, I'm gonna show you once again our setup, our journal. So based on our system, remember our system contains ATR and 20-day moving average, right? So it's a journal. I've shown you many times how you can do a journal. This will help you to identify triggered levels, entry positions. Okay, so for example, New Zealand Swiss, 1 day above the 20-day moving average. So that was when my 20-day moving average broken, the asset move above it, and form a bullish flag. So by having this kind of journal, you identify, it's easier for you to update it day after day and to identify easy um, uh, easily positions, trigger points, and etc. To identify trends as well, because you can see, for example, EuroCAD has been for 15 days in a row above the 20-day moving average and keep rising. So you have a strong uptrend over here. This is an old one, by the way. It's something that I did like 28th of December. So many things changed since then, but it's how to give you to give you an idea of how you can set your daily checklist. Over here is a combination of divergence signal, okay, lower highs on RSI, and at the same time, actually it's not a divergence, is a signal, a good one actually, because we have identified lower. It is a divergence, okay, because we have lower highs in RSI, but higher highs in the price. But as you can see, the very first indication is coming from RSI, where we have lower highs, while the price was moving and posting higher highs. So there was the very first signal, a potential divergence. So after monitoring the oil over here, we have also put a trend line by connecting the lows. So by connecting the lows on that reversal, it put another low over here, rebounded, returned back, retesting again this same area. Okay, so we had an immediate strong support level. Okay, so setting this trend line on, you should use trend lines, guys. Trend lines are also used as trigger points. Afterwards, as we have seen the asset point having lower highs, okay, lower highs, we connected these two highs over here. So you need to have, for setting a trend line, you need to connect two or more points. Okay, so by connecting these two, we have seen that it forms some kind of a descending triangle, okay, which has broken over here, trying to come up, it failed, consolidated, and eventually continue sloping lower. So that was a good entry point, that one, or even the double retest over here, that one, because it keep failing to get back up. Or if you missed all these, another entry point will have been on the breakout of this low over here, so here. Okay, so you see, it might be initially a sign of divergence, but afterwards, by setting some trend line ons and by observing your charts, you can have more signals strengthening that divergence and making you giving confidence to you that, oh yes, that divergence signal looks good, and now indeed the asset might start a new trend to the downside, and so on and so forth. Something that I haven't shown you is the significance of moving average, right? So we had this triple retest of this floor over here, but at the same time the asset start moving below the 20-day moving average, that yellow line. So the fact that it was started, it broke in the 20-day moving average and it keep extending below it, it was another confirmation for that a downtrend has started. Stops. I think we covered it pretty much. Stops can be fully or partially closed a position at a profit or loss. Stops are based on price breaches. You can set stop based on where your support level is. If you're taking a long position or if you're taking a short position, you can set your stop loss at the resistance level. So you can use pivot point indicator, or you can do it manually. So, but we have pivot point over here. Here it is. Drag and drop it, and it gives you, come on. And it gives you pivot resistance, 3 resistance and 3 support. So you can set your stop loss based on the pivot point analysis, or based on Fibonacci levels, on high and lows, on overlay barriers, and so on and so forth. Or they don't necessarily need to be based on indicators. They may not be technically based, but they might be risk or money management tools. Remember, you might have risk and reward 1, 2, 3. Okay, so so you might set your stop loss based on your risk management. Okay, or you might set your stop loss based on a fixed dollar or percentage or volatility based level. So what I mean, you have $100, okay, and you want to set your stop loss at a level at which, if you lose, you will lose only $10. So you are risking only 10% of your money. Okay, so you can place your stop loss at a distance at which, if the asset turns lower, it will be the dollar wise, it will be $10. Okay, you have a calculator. We have calculators in our website in which you can find out dollar wise your stop loss, or in the MT5, if you're using MT5, you can set your stop loss dollar wise, not pip wise. So I will leave it over here. Okay, I will finish with the very last example. Over here, I have just a informative slide. We cover all this, but it's just to give you a bit more to give you an idea to think about, to be more careful when observing the charts. Be careful, because regardless of the signals that we are getting, a confirmation of a break or a reversal will come from the price action solely. So if you have indicator signal, check your price in order to confirm this breakout or this reversal. You can use filters to fine tune the trade, avoiding false breaks, noise, and mess up. What we mean by filter: moving average, it's a filter. So moving averages, it's taking away any noise in the market and gives you a line, right? A line that either points upwards or downwards. So it smoothens the price action and it gives us a line that is clear without any noise on, and messy, and etc. So this is one filter. As an objective, you do not want to filter out all false mistakes. If you do, we'll always have big losses or very late entries or never actually enter an exit or exit. Sorry. There are different filters such as price filter, time filter, chart, volume combination. Don't be confused with the term filter. What I'm trying to say by mentioning a filter um, sorry, is I haven't put it anywhere. Oops, sorry, this is my other Chrome. So by filtering, we mean some indicators such as moving averages or support and resistance levels or trend lines. So by connecting the highs, for example, I have a trend line. So what I achieve is filter out the price. So it points down, so I know that we are in a downtrend. Okay, so it's how can I say that? By stating filter, we are referring to anything that help us. Oh, I have questions. Uh, um, anything that help us identifying the trend where the where the whether there is whether the market is driving in a trend or not, whether the overall market is bullish or bearish, identifying excluding the noise, excluding any near-term spikes or swings, and just solely focusing on the overall conditions of the trend. So filters, we are referring, when we're saying filters, we're referring to things such as moving averages, trend lines. They help us to identify the overall conditions. Okay. So for example, over here we have dollar, okay? So we connect these highs. So there was like they were up, down. We connect the highs, we connect the lows, and we have identified something like an ascending triangle or an ascending channel. So by setting this trend line, we avoided false signals such as the continuous decline of the ADX, which was pointing to a potential reversal, the continuous move of RSI below 60, so it was ups and downs, so it was indicating some kind of a consolidation, or the continuous decline of ATR. So you see, we had some misleading signals for our oscillator, but our price was keep moving within this upwards trend and above the 20-day moving average. So that's why the 20-day moving average or these trend lines are helping us to filter out any kind of false signals that the indicators are giving us. Okay, price is the best for is a very so if you are observing your indicators and you are taking signals, any kind of signals, either for divergence or for a clear signal to go up or a clear signal to go down. The next thing that you need to check is your price. Always the last saying should be on the price. Okay, everything that we mention is for every single time frame. So divergence might be something that might be observed in 1 hour chart or 4 hour chart or daily chart. But if you identify a divergence in 1 hour chart, then you need to stay to the 1 hour chart until you see the price actually confirming this divergence. Okay, so if you notice a diversion in a particular time frame, then you need to stick with that particular time frame. You need to observe that particular time frame in order to confirm whether divergence comes true or is a false signal. Yes, price need to have the last saying, dear Kenneth. Can you explain again hedging? Very, very briefly. I cannot go through that right now. We are already an hour and a half, but dear Daniel, we have hedging strategies webinar. We have many. Actually, if you go to the past webinar section, you can find me and Stuart presenting hedging strategy. But hedging, what it has to do? Okay, you might have open long positions in intraday basis, 1 hour chart, and you actually. Let me give you a better example. I think I have one. Do I have some one over here? Hedging might be one strategy. Okay, might be with correlate assets. Let's assume that you had a position on dollar CAD, but you're losing. Okay, you might consider going and taking up another position in oil on the opposite direction in order to limit your losses, the losses that you had on your dollar CAD. This is one example of hedging. Another example of hedging is when you have opened a position, let's say in gold, okay? In a daily chart, you have oh no, actually, let me give you a better example. Let me think a bit. Actually, yes. Okay, let's assume. Let me put that you have. I don't know. If you let's put a stock on just for difference. Come on. Tesco. Okay, Tesco. Oh no, let's put something big. Apple. Boeing, Facebook. Where's Apple? Where's Tesla? Never mind. Okay, we have Tesco over here. Okay. Let me get rid of the indicator, of some of the indicator, make this clearer. Delete. Okay, so we have Tesco. Okay, we decided to buy Tesco because it's in an uptrend. Okay, connecting the highs, connecting the highs as well, the highs and the actually to be correct by connecting these two highs. Okay, so we connect the highs, we connect the lows to be. Let me do it properly. Here we are. Okay, we have an ascending triangle and we have buying, We have bought Tesco. We have entered a long position. Um, um, for, let's say, we have set our target, like over here, whatever, okay? We instead, even though we bought, we have seen the asset turning lower, breaking this trend line and going against us. Okay, so what we could do is, in order to limitate losses or even end up with a profit despite this losing long position, is open a new trade, a short position with higher risk and reward ratio. With this way, we will, if of course you confirm that there is a strong pullback. Okay, so you can open a short position which has greater profit potential in order to um, end up with a profit despite this losing trade that you have opened before. So you are covering the losses of the long position with a new position on the opposite direction. There are a lot of ways. Okay, I cannot go through them right now or present you hedging strategies. Please visit our past webinars and check the hedging strategies that both me and Stuart have in the past presented. So guys, I'm gonna call it a date. I will leave you with this few slides. Anyway, we covered them, but I would like to ask for you to ask yourself, where are you placing yourself on these four scenarios? Are you a selective person? Are you an aggressive person? Are you a responsive person? Are you a choosing conservative person in regards to risk? Are you a person that risk averse with respect to time and seeking risk with respect to entry? Are you a person that risk seeking with respect to time and price entry? Are you a risk seeking person with respect to time of entry but risk averse with respect to price? So you need to for your own good, you need to check where you place yourself. With this way, you will be able to understand yourself as a trader, the risks that you're willing to take, and your approach. And with this way, you will help you setting an appropriate system based on what kind of risk person are you. Over here, I have bullish examples. Okay, I'm sure you already know the most of them. Higher highs and higher lows imply to bullish signals. Bullish volume or open interest imply to bullish signal. New highs also is a bullish signal. Swing low failures also a bullish signal. So some bullish examples. And here is a time frame confirmation on how you should, the steps that you should follow. Select a time frame that you like, if you are a person that has 4 hours of his life to spend for trading, then probably you should check trading 30 minutes chart or hourly charts, not more than that. If you are a person that it has only 30 minutes to spend in front of the PC, you might consider yourself as a daily trader or weekly trader. So you need to select time frame based on your personality, on your routine. Then looking for signal that confirms bias, bullish bias, bearish bias. Also look for multi-time frame confirmation and divergence. Then start checking for trigger levels. If you find some, then identify your stops and target levels. So also identifying this triggering entry level stop and targets are split into two parts. First of all, you can base your stops and targets based on your risk management personality, or by determining based on the enter at reduced exit re-enter remaining cash steps that we have set in advance. So using technicals to identify an entry point, adding to the position or reducing the position if it comes against you, where you should put your exit level. We said you can use ATR for that, you can use Fibonacci's, you can use Ichimoku, you can use Bollinger Bands, etc. Or you might consider re-entering the market, but always risk just a small amount of your cash and leave some cash in the balance, not blow out your account. So that's it from me, guys. I need to call it a date. I will send you right now the PDF version. Don't worry about it, Kenneth. Please feel free to send me anything that you haven't understood from today's webinar. I will be really glad to reply to any questions that you have. I think I am replying to your questions on time. I'm trying my best to provide screenshots and etc. So if anyone has anything, maybe I missed a question, I missed an email from him, let me know, okay? Yeah. So thank you very much for attending. I wish you a great day ahead. Take care. We have today pretty much the focus is turning to the inflation from Canada and to Mr. Ballet, the governor of Bank of England. So take care, because in less than an hour we might see some volatility returning into the markets because of the Canadian inflation and because of the speech of the Bank of England President Mr. Ballet. So take care, and I'll see you again tomorrow, because we're gonna host a live on Facebook and YouTube. Thank you very much. Have a great day ahead. See you again later. Bye bye.